Morning. You had me here 4 years ago and you've invited me back. Something must have been done right. Last time I came here I did a bungee, so I'm not doing that this time. I did go to the top of the Sky Tower yesterday and thought 192 meters. But I didn't want to let Steve down, so I'll do that tomorrow. I think some of you may know me. If you do, then you probably read my blog, thefinancer.com, where I've been blogging every single day for over a decade about banking and technology, because I'm seriously boring. That's the reason why I wear a suit and a tie, one of the few. Or maybe that's because I'm British. I also get involved in lots of other things, so if you haven't been aware of a thing called Fintech Insiders, it's a podcast that's released 3 times a week and is doing particularly well talking about all things in technology and finance and payments that are shaping the future. And this morning I thought I'd take you through very quickly a summary of my last 3 books, which is quite a lot to try and do in 40 minutes, but I'll give it a go. And it's really all about how technology is fundamentally shifting the whole of the financial markets, the whole of our industry. Everything that we do is being transformed by technology. A great example is I used to work as the head of strategy for the financial markets for NCR 20 years ago. And we had a sister company called Teradata. And you may know Teradata, they're still around. And Teradata provide the analytics to sift through terabytes of data and work out modeling around customer behaviors or risk or whatever you want to use it for. And it could only be afforded 20 years ago by companies like Walmart or Citigroup, because these boxes cost millions to do this analysis. Today, 60 terabytes of data is uploaded to the internet every second. That's an incredible amount of data. A lot of it is useless. It's just Snapchats and updates to Facebook, not something that you feel is valuable. But nevertheless, 60 terabytes of data every second is a phenomenal amount of data and digitalization that's transformed this planet just in 20 years. And you can see that coming through in how we value companies today, because the most valuable companies today are digital companies. The industrial era entities are disappearing because we're digitalizing everything. And that means that for companies that came from the industrial era, that made everything and built everything and had thousands of people to produce a valuation of a company, that today can be created just by a few hundred people, coding. And the main thing about coding is it's connecting people who have something with people who need something. The people who have a room are connecting to people who need a bedroom. The people who have a car are connecting to people who need journeys. That's the transformation, because the platform just connects people who have something with people who need something. And we haven't seen this impact payments and financial markets much until now. And right now, that transformation is coming through with open banking and all the stuff that Steve just talked about. We're seeing it come through in terms of companies like PayPal that have just been spun off from eBay being the valuation of 4 Deutsche Banks, near enough. 3 Deutsche Banks, got my maths wrong. Well, actually today probably is 4 Deutsche Banks, maybe even 5. Stripe, a 5-year-old company in 2016, producing 22 times more value than JP Morgan's employees. This is what the platform revolution is all about. And it's creating a banking battlefield where banks are fundamentally being challenged and payments companies challenged to keep up with this technology transformation. Because most of the banking industry and the payments industry came out of the Industrial Revolution. It came out of the physical distribution of paper in a localized network focused upon buildings and humans. Letters of credit, bills of lading, checks, cash. That's the business model of the industry that we built. And now we're trying to digitalize that industry. Equally, there's many other players coming into this industry because they think they can do it better. So 20 years ago, I was seeing Virgin and Walmart and many companies coming into banking saying, we've got cooler brands than you've got. We can do this better than you can. They were wrong. They're still trying and not succeeding. You've got a whole load of digital challenger companies coming in. And in the UK in particular, we see many of these companies. Right now, I can count over 50 new banks being launched in Britain, along with thousands of fintech companies doing payments and trading and other services. And they are fully digital, but they have no customers. So their challenge is how to actually get people to switch, to actually move to their services. And then we have the final entities that are truly digital and that we really do worry about, which are the large tech giants, the Amazons, the Googles, the Facebooks, the Alibabas, the Tencents. What are they going to do in financial services? So I thought I'd talk through this financial landscape through the morning and give you some ideas as to where I think it's going. And if we look at the basics of the financial markets, most of our industry was launched 200 or 300 years ago as a licensed, regulated marketplace backed by governments that allow industries and economies to survive and thrive. And the financial markets are critical to successful economies. The two go hand in hand. Government and finance and payments and banking are very much aligned together. And if they work together in that good alignment, you get stellar results. And the main innovation back then was the invention of the check in the post. What a phenomenal idea that was. It worked. It enabled cross-border trade because you could trust that you were good for the money because you've given me a check from a bank that's good for the money because the bank's good for the money because it's backed by the government. Fantastic. And this business model is the model that we built and that we still have around in some cases today. In particular, my American clients often send me checks in the post. It annoys the hell out of me because it's going to take 28 days to process some of those checks if they're worth more than $10,000. Why not just wire the money? Do it immediately. That's what we need. We need fast and almost free networking, not this slow and expensive old networking. But it's difficult to break the shackles of that past when it means remodeling the bank, retooling the industry, rethinking the way we do everything from the ground up for this digital age. In fact, when I look at the model of most institutions involved in money, they have the same structure. They have a back office that's all about the products, administration, services, and then that's linked through an infrastructure to the front office, which is all about being good with customers, ideally. And this business model is something that's been around for a long time. There's a lot of banks that try to build global universal structures that do all of these things across all of these lines of business, across all of the world, and they failed. All the big global universal banks have scaled backwards. And now most global banks are only global to support institutional clients, large corporations. But the model is fundamentally flawed because it's all about the physical distribution of paper in a localized network focused upon buildings and humans. And because of that industrial era model, we built and controlled everything across all those lines of business and structures, front, middle, back office. And banks and payments institutions do some things really well, but they do many things averagely and some things really badly. You cannot do everything well across all of these maps of structures of lines of business, front, middle, back office, particularly if you built it all yourself and control everything yourself. Because today it's all about the digital distribution of data through software and servers on a globalized network. And the big difference in this new structure of open systems is that's exactly what they are. They're open for all players to play. Anybody can launch into this map of functionality something that's a simple plug-and-play code, like Stripe. 7 lines of code, making it easy to do a merchant checkout online, and now going global. They're everywhere. So if you think about your structures, whether you're a bank or a payments company or a card or processing company or even a systems company, your back, middle, front office, your back office typically is focused upon your products, your middle office upon platforms is what should focus today, and the front office on experiences. This is a new model. And start with the customer. Nearly every fintech company, every new company that I'm talking to starts with customer centricity. So they start on the right-hand side. They never start with their product. They start with what is it the customer's trying to achieve? What's the intention of the customer? How can I connect the customer with what they need through a platform? And when you look at this, you can see it's very simple. I mean, if you need a ride, connect me to a car through Uber or Lyft or Grab. And Uber and Lyft and these platform services can only exist because they have connectivity through APIs between the front and back office. If Google Maps APIs did not exist, you would not have a taxi ride service because they couldn't find the car. They couldn't find your location. If Stripe didn't exist, you couldn't just jump out of the cab. couldn't jump out of the car without getting cash out. But these APIs are what's backing this revolution. If you need a bedroom and connecting to someone who's got a bedroom, then again, you need to have that marketplace of APIs in the infrastructure, in the platforms, in the middle, to provide all that connectivity. Now, I only heard about this for the first time in financial markets on March the 30th, 2005. Take note, 13 years ago. So this has been around for quite a long time. But what I heard about was a new idea on March the 30th, 2005, of when people need to buy something like a car, connecting them to people who have the money to lend them to buy the car through a platform that works with algorithms. And the presentation was from a company starting up in the UK called Zopa, a peer-to-peer lending company. And at the end of the presentation, we all walked out saying, what the heck was that guy talking about? This is stupid. An eBay for money. Who the hell's going to use that? And now that's got over 7% of the new personal lending market of the UK for consumer loans and credit. And it's doubling year on year. It's lent over £3 billion in the last 10 years. But it doesn't lend. It just connects people who have money with people who need money. That's the point. They're not a lending institution. They lend nothing. They just connect people who have money with people who need money. In fact, what we're seeing is this whole revolution being driven by technology. And it's the front office apps connecting through the middle office APIs to the back office analytics. And the back office is where all the data is. That's where the critical feeds are for the front office. And when we look at that structure, we can see lots of companies doing one thing brilliantly well in this map of the model of finance, rather than trying to do everything averagely. Rather than building everything ourselves, thousands of specialist companies are doing one part of this puzzle brilliantly well. A good example is when we look at the front office and we think it's social mobile. It's not social mobile, it's the internet of everything. Everything connected, from my clothes to my kitchen to my car, through the Internet of Things. And all of these things can now transact and trade. And it's viral, because everything is connected. Everything can immediately connect in real time, anywhere in the world. I still remember when I was in NCR 20 years ago, a journalist said, "Chris, are you seriously telling me that someone one day could make a payment from the top of Mount Everest?" I said, yes. And 3 years ago, someone did. Standard Chartered Breeze sponsored a Mount Everest climb. When they got to the top, they made a payment. It was just a gimmick, a PR stunt. But yeah, you can pay for anything, anywhere, anytime, anywhere around the world, in real time, to anyone else, anywhere, anytime, anywhere in the world, in real time. That's the point. It's completely viral. It's illustrated well by these two guys. This is Iqbal and Andy, 26 years old in 2010. And Iqbal goes to spend the weekend with Andy and forgets his wallet. What a pain. Andy's writing down through the whole weekend what he's subsidizing Iqbal for. So $2.50 for a cappuccino, $5 for a panini, $10 for the martini. At the end of the weekend, he gives Iqbal a scrappy piece of paper with lines of writing on, and you owe me $185.23. And Iqbal says, oh, I'll send a check in the post. But then they go, hold on a second, we're millennials. We're coders, as you can tell. Why don't we code something? And so they coded something and they called it Venmo. And Venmo then got turbocharged by PayPal to become the biggest social mobile wallet in the world, and definitely in America. Having said that, the numbers are not that big. You know, last year, Venmo processed near enough $40 billion. You may say, that's a good amount. But Zelle was launched by the American banks and processed $70 billion last year to compete with Venmo. So it's not so big. But having said that, it's viral. If someone sends you a note saying, you've got money, download Venmo, of course you're going to download the app. Why wouldn't you? You've got money. You're going to download anything if he's told you it's got money in it for you. It's these apps that create that connectivity, that virality, so that everybody starts to download and connect. And then they need to connect to something, and how they connect is through a marketplace, a plug-and-play software in the middle, the APIs, of which there are thousands of APIs out there, of plug-and-play code. Again, I was talking about this 10 years ago, banking as a service, using APIs of plug-and-play software to build my own bank, getting 1,000 specialist companies that do one brilliant thing well, and building the Bank of Chris. You can do that. And that's all parts of the financial structure, not just payments. It's every single aspect of how we deal with money that's being dropped into plug-and-play software by 1,000 specialist companies that focus on one thing well. And some of them do it so well that they become very rich. When Patrick and John Collison started Stripe, John was a teenager. Teenagers, because they can code, are transforming payments and finance. Teenagers, because they can code, can produce just 7 lines of code and become the youngest billionaires in the world. Nice. If you can code, if you've got vision, if you've got mentors, if you can scale, which they can. But really, where the biggest battle for the banking and the payments future lies is in the back office, because this is where the data sits. And right now, we talk about big data and cloud. We talked about that 10 years ago. Today, we talk about machine learning and artificial intelligence. And a lot of the institutions that I'm talking with are doing this wrong. A good example is we have a startup bank in the UK called Monzo. Monzo enrich every transaction with information, so you know exactly what you were doing when you made that transaction. Linking to Google Maps, it shows you exactly where you were when you made that transaction. Linking with PFM and other visualization tools, it shows you categorically how you're living your financial life. As a result, I have lots of friends who regularly move money to Monzo, and originally it started as a prepaid card, now it's a full bank. 500,000 customers, 93% of the prepaid card users switched to the full service bank account. But what actually happened when it was a prepaid card is my bank statement says, Monzo, £200. Monzo, £200. Monzo, £200. Because I'm topping up Monzo all the time. My bank has no idea what I'm doing anymore. They've lost my data. They have no idea where I'm living my life, where I'm spending, what transactions I'm making. All they know is Monzo's got my business. That's what's happening with data. That's the battlefield. And the biggest battlefield is going to be around these 2 technologies that have already been touched upon, artificial intelligence and blockchain, distributed ledger technology. You cannot be leveraging customer data in artificial intelligence if you have dumb systems that are fragmented and structured and focused around products and stuck in heritage structures. This is the biggest challenge for most developed financial institutions and markets. It's the biggest challenge for Swift, Visa, and MasterCard. How can they reinvent themselves for the real-time digital age when they were built in an era where things were very slow and structured? Citibank made a forecast that an awful lot of jobs are going to disappear in banking. Well, an awful lot of jobs are going to disappear everywhere as we automate everything. And we have different levels of artificial intelligence. Right now, we have just artificial intelligence where a machine can do one thing brilliantly well. Soon, a machine can do several things brilliantly well, so it could play Jeopardy, chess, and Go, rather than just Jeopardy or chess or Go. And eventually we get superintelligence, when machines become more intelligent than humans, around 2030, 2035. In financial services, we're using it for many different aspects, but an awful lot of it is going into risk and fraud analytics. Some of it is going into customer intelligence, servicing, and marketing, but most is not, because most systems and most financial institutions do not have an enterprise view of the customer. They have fragmented views of the customer. So they use it for risk and compliance. A great example is JP Morgan launched an artificial intelligence system last year that in 1 second can analyze their contracts that previously took 360,000 hours of legal time. So we can lay off all the lawyers. This is a good thing. But actually, there's lots of other things that are happening with artificial intelligence already. So UBS, for example, take high net worth client instructions that historically would take an average of 45 minutes for a human to administer and automate the whole thing through AI so it's done in a nanosecond by the machine. Change my portfolio of risk, invest in Microsoft stock, sell my IBM stock, whatever the instructions are, they do it automatically in seconds. In fact, I'm so sad I actually wrote a book about a thing called MiFID, which is the Markets in Financial Instruments Directive. And it's all about the investment markets becoming automated. And one of the things in the MiFID regulation is best execution. And it's defined as 4 different quadrants. You can either ask for the best price, the lowest cost, the fastest speed, or the highest likelihood of settlement. as what your 4 areas of best execution dynamics. And clients can sometimes say, on this investment, I want you to make it at the best price. On this investment, at the fastest speed. On this investment, at the highest likelihood of settlement. On this investment, all 4. No human could do this administration. High frequency, algorithmic, low latency trading. There is no way a human could keep up with any of those instructions. But a machine can. So artificial intelligence for compliance within JP Morgan via best execution makes absolute sense. And the result of all this is a lot of humans disappear. Goldman Sachs used to have 600 traders sitting next to the CFO. Now, because of his personality, there's none. You know, UBS 10 years ago, this is 2005, their New York trading office. If you can't see it, make it a bit bigger. You know, 2005, this was UBS's New York trading office. Today, there's no one there. This is what's happening. We're automating everything that can be automated. Software is eating the world. If we can code it, we will. And then we get into this other technology that's incredibly complex called blockchain. And to me, blockchain combines everything you don't understand about money with everything you don't understand about technology. It's really complicated. But having said that, it's the foundational change for the next generation of the internet, for the next generation of everything. Because we can now suddenly build databases that we can share with people we don't trust. And it's easy. We can share anything with anybody, anywhere. And they can update and transaction. Because once a transaction is recorded on a blockchain distributed ledger, then it's immutable, which means you can't tamper with it. It's there for eternity. It cannot be changed. And I'm not going to talk a lot about blockchain. I think Dave Birch probably will talk a bit more tomorrow about it. Or equally, if you're that interested, my previous book before the newest one, Value Web, talks about blockchain in depth. Because it is transformational, but a lot of it has to have agreements before it will work. And a lot of what we got excited about was, we've got this horse called blockchain, fantastic. Now go and design a cart that it can pull. And that takes a lot of time because there's so many counterparties involved. How can you build a digital identity scheme using distributed ledger technology when we can't even agree how an identity scheme works? That's the reason why we have so many people involved in consortia around distributed ledger technology, to try and resolve the standards and try and work out how to apply the technology by defining what the problem is it's solving and who's involved in that problem. And how is it going to be solved? It's easy for the Australian Stock Exchange to go and use digital asset holdings because the Australian Stock Exchange controls the stock exchange. It's just one entity. Try and get all the stock exchanges of the world to use the same distributed ledger technology, and that takes ages. So we have all these things like the Enterprise Ethereum Alliance, with all these institutions like JP Morgan and BBVA working on these ideas of standards and interoperability in shared ledger systems. But the one thing for me that resonates the most is the guy who invented Ethereum, who wrote Ethereum, is Vitalik Buterin when he was 19 years old. Teenagers are reinventing the future of our world because they can code. This is the critical point. Kids code. They get it. They understand this map of technology for the new business model of finance. How well do we understand it? How well are we dealing with it? How well do we know these thousands of startup companies doing one thing brilliantly well? And how do we work with them? Particularly when an awful lot of these fintech startup companies doing one thing brilliantly well are kids. They're under 30 years old. They're reshaping and rethinking the way we live our lives with code. What does that mean for a bank's business model? What's interesting for me, because I've used to very rarely talk about big banks as digital banks, but I can see a few that are becoming digital banks, like Goldman Sachs. Goldman Sachs, incredibly, in the last quarter of 2017, had 1 in 4 jobs advertised with the word engineer in the title. Banks are hiring coders, not bankers. BBVA, lauded as one of the most innovative, visionary big banks out there when it gets to digitalization, has been doing this for over a decade. And they have a model that looks at everything from finding the fintech startups to work with, working with them, investing in them, acquiring them, and integrating them into their business. One of the top blogs I ever wrote based on reading and views was the best job in banking is Chief Cannibal Officer. BBVA have two chief cannibals, one looking at the external world, seeing who can eat their business and working and partnering with them, and one looking at their internal world to try and work out how can I destroy our business. Because if I can destroy our business, then that means someone else can. So let's work on reshaping the model, rethinking what we're doing. DBS has done this very well, Development Bank of Singapore, a civil servant bank taken over by Piyush Gupta in 2009 that now describes itself as a 24,000 employee fintech startup. How do you get that mentality through the organization? It's very difficult. This is cultural change. It's not technology change. And in the future, I think financial institutions have three roles. The first is to be my asset manager, not just of my physical assets, but of my digital assets. I have a lot of digital assets these days that I want to be protected. Not just intellectual property, not just contracts, but memories. You know, I've got 15 years worth of digital photographs. And if some of them are on Facebook, if Facebook deletes my account tomorrow night, I don't care, because I still have them backed up on a hard drive. If my hard drive gets corrupted, I do care. Who's storing my memories? And equally, as Steve pointed out, I can't trust this guy to store my memories. Where is the trust? You know, the trust needs to be in some form of secure data vault. There's 60 terabytes of data being uploaded every second. How much of that is valuable? 60 gigabytes, 1%. So how much would you pay to protect your 60 gigabytes a second of value? And where do you want it put? And how do we secure that for you? And how will this work? That's one role. The second role is to be a life events manager. The Royal Bank of Canada recently came out and said this, which is that their idea is to work in an API marketplace that looks at the key life events that happen to you, having a relationship, moving in together, having a kid, losing your job. You know, these key events and building a complete API marketplace integrated around those life events. So if you're buying a house, we're not just going to give you a mortgage, we're going to give you all the APIs that integrate from getting the removal van to taking out the insurance to getting painters and decorators to getting gardeners. Everything you need for the whole house-moving, home-making experience, not just the money. In fact, I was recently at an event where one of the banks was talking about when you have a car accident, wrapping around that event so that you don't actually have to do anything except go, geez, that was bad. The car and your phone will do everything for you through the bank's API marketplace of connecting to the tow truck, of connecting to the taxi ride home, of connecting to whatever you need when that happens. So the bank of the future to me is a data vault, a life events manager, and a curator of 1,000 things that companies are doing really well. Because I don't want to go to 1,000 companies doing one thing really well and do the due diligence on them and build the bank of Chris. I want my financial institution to find them and bring them to me, and for the financial institution to do the due diligence and say, you can trust these guys. This is a chart used by many presenters in the fintech world about the unbundling of the bank. But today, we've got the rebundling of the fintech. JP Morgan and many other institutions are rebundling fintech into great experiences through platforms for their customers. They're moving away from being control freaks to being co-creating partners. And in doing so, one of the biggest challenges they have is working with the kids. Because Fin is the parent. Strong, stable, resilient, robust marketplaces that don't crash. Tech is the kid. Go around, kick everything, disrupt everything, challenge everything. Again, this is illustrated really well to me by the introduction of a fintech partner of one of the big banks in the Nordic region. And the head of innovation for Nordea, Ewan McLeod, said, I'm delighted to welcome Carl Nicolai, the CEO of Spiff, as our fintech partner. Carl Nicolai. And Carl Nicolai's first words were, my 3-year-old son likes to play with dinosaurs, so do we. How respectful is the child of the parent? Not very. But I can see where he's coming from, because when I walk into most banks' boardrooms, I'm met by a group of old men. You know, it feels a little bit like a dinosaur sometimes. Where's the diversity and vision? Where's the digital in the bank? You know, 94% of the big banks' C-suite and boardroom leaders have never had any experience of technology in their life professionally. How can they create a digital vision and a cultural change for digital transformation if they're legacy leaders? This is a huge challenge. And finally, getting to the end of where I'm going with this, Really, banks keep talking about they're becoming technology companies that happen to have a banking license. And then we have these big technology companies that are moving into finance. But they're very different, because the big tech giants are not moving into finance and payments because they want to get into finance and payments. They're moving into finance and payments because it gets more sales and commerce on their platforms. So it's an adjacency. Amazon does not want to be a bank, but they want people to buy and sell more through the Amazon platform. That's the reason why they're launching stores with no checkouts. Spend more, live your life more easily, using our APIs, just enjoy yourself. So they're in payments and lending and credit, not to make money out of payments and lending and credit, but just to basically leverage more through their platform. Having said that, a lot of people talk to me about GAFA, Google, Amazon, Facebook, and Apple. And I go, well, they're kind of American companies, and Europe and America has this problem that actually nearly everything in Europe and America is legacy, because it was implemented before Mark Zuckerberg was born for nearly all of our infrastructure. And then I go to China, and I find something completely different. So in my newest book, Digital Human, a third of the book is about Alipay. And the reason it's about Alipay is Alipay thinks very differently. In fact, it's evidenced by when we launched the book in London in April, and Li Wang is the head of Alipay Europe, and Ashok Vaswani is the head of Barclays Bank UK. And Ashok was talking about how Barclays Bank has survived over 300 years of history. It survived 2 world wars. It was created before America was born. So it can deal with change. It can deal with what's going on today. And then Lee, in the middle of her discussion, said the average Alibaba employee generates $16 million a year of revenue. And Ashok's face dropped, because Barclays' average employee produces $400,000 a year of revenue. This is the difference between a tech company getting into finance and a financial company deploying tech. Most of the financial companies deploying tech are leveraging an old industrial era model. The tech company comes in with a completely new, fresh look. That's the reason why China's leapfrogged America and Europe, making $15 trillion of mobile money payments last year, 55% of which goes through Alipay, 38% through WeChat Pay. It's the reason why Alipay is used more than cash. And the reason I chose them for the book is that Eric Jing, their CEO, last year at the World Economic Forum said their aim is to have 2 billion users by 2025. And I thought, there's 1.2 billion people in China, where are the rest coming from? And they're coming from all over the world. In fact, I don't have time to go through this in depth, but it's amazing, the vision of Alipay. They're already on their 5th generation systems architecture. That means that every 3 or 4 years, they throw away their systems and start again from scratch. Why would they do that? Well, the current systems are built to handle an average 125,000 transactions per second. Visa does 2,000 transactions a second average. 125,000 transactions per second average, with every single one with bulletproof fraud and risk analytics built in through artificial intelligence and machine learning. The next generation is going to handle 1 million transactions per second average. On Singles Day last year, in the first 2 minutes, they processed over $1 billion of payments. In the first 5 minutes, they're handling 256,000 transactions a second. In the first hour, they processed $10 billion of payments and purchases. And they're going global. They're all over Europe and America with partnerships to get Chinese tourists to spend more. In Finland, which is where they have a partner that's one of my companies in Nordic Finance Innovation, a group that I chair, they partner with this company and enable Chinese tourists to come to Finland to spend money with Father Christmas. And they spent twice as long and 3 times as much in 2016. And by 2020, they estimate 8 million Chinese tourists will come and see Father Christmas. There's only 5 million people in Finland, so you're suddenly going to find all these Chinese tourists there. Europe's becoming the museum for Chinese tourists. That's what we're seeing. And if they can allow Chinese tourists to spend all that money coming 6,000 kilometers from Beijing to Lapland, why can't Europeans use the same wallet? And that's exactly what the plan is. That over time, Alipay will be localized in languages across the world for anyone to use as a mobile wallet with QR codes, already accepted at all merchants across Europe for Chinese tourists. They're also partnering across the world with many other companies to enable financial inclusion. My favorite example is Paytm. mainly because Vijay Shankar Sharma, who founded Paytm, is now India's youngest billionaire with a company valued at $9.3 billion, thanks to the cooperation through an API marketplace with Alipay. But Vijay Shankar Sharma was homeless 10 years ago. Now he's India's youngest billionaire. And Ant Financial is one of the top 10 financial companies in the world by valuation. Having said that, the one thing that these companies haven't yet encountered is the regulator. And they will. If data is money, then data has to be regulated as money. And right now, financial institutions deal with 5 times more regulation than technology companies do. That will change. So in conclusion, what we have today is banks who have millions of customers, billions of capital, and centuries of history hampered by heritage and legacy, faced with lots of startup companies that have no customers, limited capital, and no history, and no trust, therefore, but they're driven by vision. And then these massive tech giants that have billions of customers and billions of capital, and they've got the vision and drive. The challenge for the fintech companies is that they're young, but they're also a little bit naive. They learn gradually why we have the regulations that we have in finance. The challenge for the tech giants is actually they're not getting into banking and payments because they want to be in banking and payments. They're getting into banking and payments for the adjacencies. And stop looking at GAFA, Google, Amazon, Facebook, and Apple, and start looking at Fatbag. Facebook, Amazon, Tencent, Alibaba, Baidu, which is a Chinese search engine, and Google. And the banks can deal with both these startups who are naive and these tech giants who are coming from the East and the West if they reinvent their boardroom for the digital age and get rid of the generation that doesn't understand digital and start with changing the culture and the organization. Thank you.